Hi everyone, you're at the front of finance. My name is Sneha Pasricha and this is the first course, Investing 101, Lesson 3, Introduction to Stocks and the Stock Market. So in this lesson, we'll learn about stock, the stock market, stock exchange, and the implications of investing in stocks, so the pros and cons. Let's first start off with what is a stock in the first place. A stock basically represents the ownership of a company. So when you invest in a stock, if you invest in a share of a company, you own a fraction of that company. You have partial ownership over that company. Stocks are typically bought on or sold on stock exchanges. For example, in the US, it's NYSE, and in India, it's NSE and BSE. Stocks are non-tangible financial instruments, and if we connect this to our previous learning on assets, stocks are financial assets. Stocks, shares, and equities are all terms that can be used interchangeably, like what I just did. Why do we invest in a stock in the first place? So stock ownership, like as a shareholder, grants you rights and potential benefits. Companies issue shares to raise money from investors, and actually a source of external finance of businesses is capital, is share capital or equity capital. So the money that comes from investors, which is called a shareholder in this case, is this capital that's raised is used for the growth of the business. And as a shareholder, from the POV as a shareholder, you may have the opportunity to participate in the company's growth and profitability through capital appreciation. And hence, when the company grows in the market, the price of the company's stock also increases, which is known as capital appreciation, because a portion of the company's net profit goes into your pocket as a shareholder. So a part of the net profit goes to shares. So as the company grows, their net profit also grows, and so your stock also increases in value, and this is called capital appreciation. So now that this capital appreciation has happened, this allows you to potentially sell that same stock at a higher price than what you paid for it because it's appreciated. So this earns you a profit. Stocks are a popular investment option because they require low principal and offer potential for long-term growth and high returns. You may have heard the terms stocks and dividends, so let me just differentiate between the two. Stocks are just units of ownership in a company that represent a portion of its equity. So if you own a stock or a share of a company, that gives you a unit of ownership or units of ownership, and this represents a portion of its equity. Dividends, on the other hand, are distributions of a company's profit paid to shareholders. It's distributions or a portion of the company's net profit that's paid to shareholders. So this portion is called dividends. So part of the net profit goes to dividends, and the remaining that's left is the profit that the company makes at the end. So shareholders who own stocks in the company are eligible to receive these dividends based on whatever policy that the company has on dividends, but also it depends on the number of shareholders of this company, because obviously if the net profit has to be divided between a larger number of shareholders, you as one of the shareholders would only receive a small portion of the net profit, compared to if there were a smaller number of shareholders, you would receive more money because the dividend would be more, and so you as a shareholder would get a larger portion of the net profit. The stock market is a virtual platform for buying and selling stocks. So in a stock market, companies basically list their shares for public trading. So they list their shares to the public, allowing investors to buy and sell those shares. The stock market is actually quite transparent, and it can be really regulated to conduct these transactions. Because it's virtual, it allows you to do that. So you can clearly see and you can regulate your stocks by seeing how much they appreciate over time, because it's so transparent. You can see graphs of your money appreciating over time. How does the stock market operate? Actually, the market operates based on supply and demand dynamics that were defined by economics supply and demand law. So a larger number of buyers means there's a higher demand for the stock. That means there'll be a higher price for the stock. But if there's a few number of buyers for the stock, which means a lower demand, then there'll be lower prices. Besides just supply and demand dynamics that impact the price of a stock, there's also company performance, economic conditions, inflation, deflation, crisis, and recession all tell you about how a market is performing. Industry trends, investor sentiment, this is where psychology comes into play, where behavioral economics come into play. Basically, the emotional state of investors influences their trading decisions. To further understand the stock market, we have to understand the bull and bear market. So, when a market is referred to as a bull market, it refers to a major upswing in the markets. Bull markets often correspond to periods of economic and job growth, whereas a bear market is a time where there's a pronounced market downturn. Bear markets are often tied to periods of economic decline and a shrinking economy. Historically, bull markets tend to last way longer than bear markets. But we can say that bear and bull markets can affect investor confidence and behavior, because obviously as an investor you would like to invest when there's a bull market, because there'll be a higher chance of your money appreciating to the amount that you wanted to appreciate to the maximum amount, like compared to a bear market where it wouldn't do so well, the stock wouldn't appreciate as much. So there's a stock market and there's a stock exchange. You might think that they're the same thing, but they're actually not. A stock market is just a broader concept encompassing all activities related to buying and selling, but a stock exchange is just a specific marketplace or a specific platform where the actual buying and selling of stocks happens amongst the investors. There's actually two types of stock markets. The first is the primary market. The primary market is where businesses issue and sell new shares for the first time directly to investors. And this happens through the initial public offerings. In the initial public offerings, the company sells shares to the public for the first time. In this case, the company is selling shares to investor A. So it's only between the company and investor A. But the secondary market, on the other hand, is between investor A and investor B. Investors, in this case investor A, trades previously issued shares from the company amongst other investors. And the stock exchange is what allows this trading in the secondary market. So the secondary market is allowed because of this stock exchange. It's a platform for the investors to buy and sell and trade. There's also a lot of risks of investing in stocks. The first one is that the market is highly volatile. It's quite unpredictable about stock prices, the fluctuation of stock prices, because they can fluctuate rapidly because of news events, economic conditions, or investor sentiment. And so this would lead to fluctuations in the value of one's investment. And you can say that this market volatility reduces consumer confidence, because you as a consumer, you would be unsure about what stocks to invest in, because you know that the market is so volatile. You don't know if this stock would do well and if it would appreciate. There's also individual stock risks. The value of a single stock can actually plummet if a company faces financial problems. Like I mentioned, the value of a single stock is dependent upon the net profit of the company. So if the company is facing financial problems, their net profit goes down. And so a lesser portion of it goes to dividends. And so a lesser portion of it goes to you as a shareholder. And so the amount of profit that you make, or the amount that the stock appreciates, would decrease. However, these risks can be mitigated through diversification, and that I will explain in the next slide when I talk about the benefits. There's also a large possibility of frauds and scams. So, companies or funds must be thoroughly researched by the investor to ensure legitimacy and a track record of success to avoid fraudulent activities whilst trading online on the virtual platform. Along with the risks, there are actually a lot of benefits of investing in stocks, which honestly outweigh the risks. There's high potential returns. Historically, stocks have outperformed other types of investments such as bonds, real estate, or savings accounts, and thus offer a potential for really substantial gains. Diversification is actually a tactic of investing in a diverse range of stocks to reduce the risk of feeling the effects as an investor from the market volatility and if a company has financial problems. So even if there's fluctuation of one certain stock, even if the stock reduces of one, you still have the other remaining stocks that are not fluctuating and they're remaining constant. So you kind of have a safety net if one stock doesn't appreciate as much as you want because of some market volatility or the company having financial problems. Also, investing in stocks gives you protection against inflation. The rising cost of goods and services grows along with your investments. The stock values increase over time, and your investments can grow in value alongside the rising cost of goods and services. So you and your wealth is protected from eroding effects of inflation and also maintains the purchasing power of money. So you are saved from inflation if you have invested in stocks, because your stocks increase in value over time the same way that the cost of goods increase in value over time. Let's go into success stories. The first success story that we picked was Warren Buffett. He bought his first shares of textile company Berkshire Hathaway in December 1962, only for $750 each. And the cost of the same share today is $520,000 each. There's also Tesla. Tesla went public in June 2010, so their initial public offering was priced at only $17 per share. A $10,000 invested in Tesla back then would now be worth more than $2.9 million today. Thank you for listening, and I hope you learned something new.